October 22nd, 1907. One library. $25 million locked behind oak doors. Not a vault, not a bank, a library. The private reading room of J.P. Morgan on Madison Avenue. And for the next 72 hours, this room, filled with leather-bound books and first editions, would become the command center for saving the American financial system from total collapse. Here's what doesn't add up. America had no central bank in 1907, no Federal Reserve, no lender of last resort, just a handful of private trust companies, a fragile clearinghouse system, and one 70-year-old banker who had to personally decide which institutions would live and which would die. The panic that started in a single trust company would spread across New York, trigger forced liquidations, freeze credit markets, and force Morgan to lock the doors of his library and refuse to let anyone leave until they had signed away their independence. This is the story of how a private liquidity pool became clearinghouse certificates, how those certificates triggered a margin call cascade, and how one weekend in a library directly wrote the Federal Reserve Act of 1913. To understand why a library became America's de facto central bank, you need to understand what came before it. Since Andrew Jackson killed the second Bank of the United States in 1836, America had operated without a central banking authority for over 70 years. No lender of last resort, no mechanism to inject liquidity during a panic. Just a patchwork system of national banks, state banks, and, the newest and most dangerous players, trust companies. Trust companies were the shadow banks of the Gilded Age. They could take deposits, make loans, and underwrite securities, but they operated with far lower reserve requirements than national banks. Where a national bank had to hold 25% of its deposits in cash reserves, a trust company might hold as little as 5%. This leverage worked beautifully in good times. Trust companies proliferated, their assets growing from $400 million in 1890 to over $2 billion by 1907. They funded railroads, underwrote corporate mergers, and speculated heavily in stocks and real estate. But there was a structural flaw. Trust companies borrowed short from depositors and lent long to risky ventures. They were profitable but fragile, and they were deeply interconnected through a web of cross-holdings and personal relationships. The system had one other problem: seasonality. Every autumn, money flowed out of New York as farmers withdrew deposits to finance the harvest. Interest rates would spike, credit would tighten, and the system would hold its breath. In 1907, that breath would become a gasp. The trigger was a failed corner. In October 1907, two speculators, Fritz Heinze and Charles Morse, attempted to corner the stock of United Copper Company. They borrowed heavily from trust companies to buy up shares, betting they could force short sellers to cover at whatever price they demanded. But the corner failed. United Copper's price collapsed from $60 to $10 in 2 days. The trust companies that had financed Heinze and Morse faced massive losses. On October 16, 1907, the Knickerbocker Trust Company, New York's third-largest trust, announced it could not meet withdrawals. Depositors ran. Within hours, Knickerbocker's reserves were gone. It suspended operations. Here's where the mechanism gets interesting. Knickerbocker's failure should have been contained, but trust companies were so interlinked through loans and deposits that one failure became many. The Trust Company of America, which had tried to save Knickerbocker, now faced its own run. Then the Lincoln Trust, then others. By October 21st, the entire New York trust system was freezing. Depositors couldn't withdraw their money. Banks stopped lending to each other. The clearinghouse, the mechanism banks used to settle checks and transfers, began to seize up. And that's when they went to the library. J.P. Morgan was 70 years old, but he was still the most powerful banker in America. He understood what the panic meant. Without intervention, the entire financial system would collapse within days. Businesses couldn't make payroll. Brokers couldn't settle trades. The economy would stop. On the night of October 22nd, Morgan summoned the presidents of New York's major banks and trust companies to his library. He locked the doors. He told them they would not leave until they had solved the crisis. What happened next was a private central bank operation, improvised in real time. First, Morgan forced the stronger institutions to pool their liquidity. They would contribute $25 million to a rescue fund. In exchange, they would get first claim on the assets of the failing trusts. Second, they issued clearinghouse loan certificates. These were emergency IOUs that banks could use to settle accounts with each other when cash ran short. The certificates were backed by the pooled assets of the clearinghouse members, not by any government guarantee. Third, and this is critical, Morgan forced the trust companies to accept harsh terms. To access the liquidity pool, they had to submit to audits, accept restrictions on their lending, and in some cases, merge with stronger institutions. It was a forced recapitalization, a manual margin call on the entire system. For 3 days and nights, the bankers worked in that library. Morgan personally interrogated trust company presidents about their assets. He decided which institutions were solvent enough to save and which would be allowed to fail. He negotiated mergers, arranged emergency loans, and coordinated the issuance of clearinghouse certificates. By October 26th, the immediate panic had eased. The liquidity pool had stabilized the system. The clearinghouse certificates had kept payments flowing. Morgan's library had functioned as America's central bank. But here's what nobody was supposed to notice. One man, acting without legal authority, had just decided the fate of the entire American financial system. He had allocated credit, chosen winners and losers, and created emergency currency out of thin air. This was not democracy. This was not law. This was private power filling a public void, and it would not be tolerated again. The panic of 1907 was over, but the reckoning had just begun. The total damage? Over 300 banks and trust companies failed. Industrial production fell 17%. Unemployment spiked to 8%. The New York Stock Exchange dropped nearly 50% from its 1906 peak. It was the worst financial crisis since the Panic of 1893. But the real crisis was political. How had it come to this? How had the most powerful economy in the world become dependent on the personal intervention of a single banker? Why did America still have no central bank while Britain had the Bank of England and France had the Banque de France? The answer, uncomfortable for the financial elite, was that Jacksonian populism had killed the last central bank in 1836, and nothing had replaced it. The system had evolved ad hoc, through clearinghouses and private arrangements, but it had no formal structure, no lender of last resort, no mechanism to prevent panics. The 1907 panic made it clear. This could not continue. Either America would create a central bank, or it would remain vulnerable to the whims of private financiers and the chaos of runs. But there was a problem. Americans didn't trust central banks. They associated them with Wall Street concentration of power, with the kind of elite control that Morgan had just exercised in his library. Any proposal for a central bank would have to overcome deep populist suspicion. So the architects of reform did something clever. They didn't call it a central bank. They called it the Federal Reserve System, a network of regional banks, supposedly independent, supposedly distributed, supposedly accountable. But the mechanism was clear. A central authority that could issue emergency currency, act as lender of last resort, and prevent the kind of liquidity crisis that had required Morgan's library. The Panic of 1907 had written the Federal Reserve Act before a single word was drafted. On December 23, 1913, 6 years after the panic, President Woodrow Wilson signed the Federal Reserve Act into law. The Federal Reserve System would have many of the powers Morgan had exercised in his library: the ability to issue emergency currency, to lend to solvent but illiquid institutions, to coordinate the banking system during a crisis. But now these powers would be public, not private. They would be governed by law, not by the personal judgment of one banker. Or so the theory went. Here's what the 1907 panic teaches us about financial architecture. First, liquidity is not optional. A financial system without a lender of last resort is a system that will panic. The question is not whether there will be emergency liquidity, but who will provide it and on what terms. Second, private power fills public voids. When the state refuses to provide essential financial infrastructure, private actors will step in, but their incentives are not aligned with the public good. Morgan saved the system in 1907, but he also consolidated his own power and chose which institutions would survive based on his own interests. Third, crisis drives reform, but reform is never complete. The Federal Reserve was created to prevent another 1907. It prevented that specific crisis, but it could not prevent the Great Depression, the 1987 crash, the 2008 financial crisis, or the 2020 pandemic panic. Each generation builds the institutions to fight the last war. The library on Madison Avenue is now the Morgan Library and Museum, a cultural institution filled with rare books and manuscripts. But for 3 days in October 1907, it was something else. The command center of American finance, the improvised central bank, the place where one man decided the fate of the economy. If the mechanism we just described sounds familiar, it should. The pattern repeats. Private liquidity pools, emergency interventions, the question of who controls the system. Subscribe. We cover the ledger, not the legend.